Alrighty, good afternoon everybody. This is Dan Sheridan, and today it's quite remarkable. On Thursday the 4th, it's the first down day we've had in about 7 or 8. Not a huge down day. We're down about 18 points in SPX. We're still well above the 200-day moving average, and we're only down about 0.59%. Not a huge deal, but you know, it's funny, down 18 points, considering the last 7 to 8 days we've been kind of grinding up. So what am I looking at today? A calendar trade. A little bit of a range-bound trade, but I like it because the VIX is basically the lowest it's been in 2.5 months. We're at the lower end of the range here for this volatile market, around 25-ish. Volatility a little bit under 26. So this is what I'm looking at doing. I'm looking at buying this is a 15-day calendar. It expires 2 weeks from tomorrow, which would be Friday the 5th. And I'm looking to maybe hold this maybe 1, 2, 3, 4 trading days at the most. I'd like to be out of this by next Wednesday or so. So here's the trade. I'm buying one June 26, 3105 call, and I'm selling one June 19, 3105 call, and it's going for around $12 and 70 cents debit, and that's with the underlying at about 31.02. So we're doing a kind of pretty much at the money, 31.05. And a calendar makes money because your short option is going to decay a lot more than your long option will, and you'll make your most money if it closed at the short strike at expiration, because your short strike would go to 0 and your long option would still hold a lot of value. So there's kind of a sweet spot here. Maybe if this is the expiration break even, this is the green line is your graph at expiration in 15 days. Your purple line is how it looks today. And your purple line will morph into your green line over time. But your sweet spot, and I'll show you, if you look at this, as I said, I wanted to get out of this trade probably, if today is June 4th, I would like to get out of this by, I want to be in it's a 15-day trade. Maybe I'd like to be in 4 trading days. If I go to next Wednesday, the 10th, and you can see where the purple line is here. And this purple line here represents a profit of around $130 to $170. And on your capital in a calendar is what you pay for it. So if you're looking at $130 to $170, let's take the middle there, 150 divided by 1270. It's about 11%. So this is how the graph will look on next Wednesday's expiration, a rough look. And you say, Dan, how would you make like 130 or 170? Well, a lot of it is on a short-term trade like this, a 15-day calendar. When you go 4 or 5 days into it, the theta is 40. At the beginning of the trade, right at the beginning of the trade, the theta was, let's just see here, 21. So let's take, if the theta is positive, theta is 21 at the beginning, 40 in 4 or 5 days, let's maybe take an average theta of 30. So if we're in a 30 and we put it on today Thursday, and we're going to take it off on a Wednesday, you're in at what, 5, 6 days? 5, 6 days, 5 days at 30 would be 150. So the reason we're able to get out of a 15-day trade in maybe 4 or 5 4 or 5 days, whatever, is that theta. That's the main thing. There's a lot more to it with the volatility, but that's kind of the gist of it. Anyways, that's what I'm looking at today. That's really what's been working well the last few days. Check out SheridanMentoring.com for we're in the midst of a hot and heavy, very good credit spread class. You only miss 1 of 4 weeks. You could still sign up for that. It's been a great class. If you're looking for a trade to get consistent on and just get one trade that you can develop for some monthly income, I would encourage you to join that. Check out some of the stuff we have on Sheridan Mentoring. All right, folks, thank you.